Hello everyone, welcome to today's US Open Live webinar. It is April, Tuesday the 18th, 10 minutes before Wall Street opens as usual. This is your host Nikos Zabouras, Senior Market Specialist at FXCM. Now markets have focused today on strong data from China, and they also digest recent hawkish commentary from the Fed and increased inflation expectations, which offset some of the positive sentiment from the China data that we talked about. And we also got the earnings season in full deploy. Big banks kicked things off last week, and now we have more banks and also tech giants such as Netflix and Tesla coming up. Before, however, we talk about all of that, as always, please read carefully the risk warnings and the disclaimers. Once again, please go over the disclaimers carefully and also bear in mind that anything discussed during this webinar does not constitute investment advice and should not be construed as such. Okay, let's go right to it. As always, we'll start with Euro USD and we'll talk over the developments that we've already mentioned. So Euro USD comes from another strong week, having registered its best weekly streak in nearly 2 years, during which it also set new 2023 highs. These are from late last week over here. However, it faced pressure up to that, mostly due to hawkish commentary from Fed Governor Waller, who on Friday said that the recent data show that policymakers haven't made much progress on the inflation goal, and he also stressed that there is still work to do on the rates front. So that helped the greenback and pushed the pair lower. And also on the same day, we had the University of Michigan survey, which showed that inflation expectations, 1 year inflation expectations, rose to 4.6% year over year from 3.6% previously. That was a significant change, a significant increase, in markets reacted the way we said. And there was a repricing in expectations around the Fed's policy path. Odds for another hike to 5.25% were reinforced, but more to it, optimism for cuts was moderated. CME's Fed Watch tool shows rates at 4.75% by year end from previously 4.5%. So again, the markets are really optimistic. Yes, they agree with the Fed about another hike, but after that's a different story. The Fed does not expect rate cuts, whereas the markets do. In any case, as we said, that sent on Friday the pair lower, and on Monday it finds support today. Though this today slump creates scope for perhaps a test of the 200 period EMA over here around 1.083, but a strong catalyst would be needed for a deeper and more meaningful correction. In any case, as we have said again, the downside is well protected. We can see that we have the daily Ichimoku starting here, and its lower border is where other support levels also are located, as the ones you can see here. And given the current policy rate differential, it's hard to see sustained weakness below this level. But in any case, the European Central Bank is much more hawkish with aggressive comments from policymakers. Continuing, Germany's central banker said that the job is not done and further rate increases will likely be required. And similar, his Austrian counterpart said that the persistence of inflation argues for another 50 basis points in the next meeting, which is in May. So definitely, both in terms of fundamentals and in terms of technical analysis, bulls are in control here, and they can set new 2023 highs towards 1.1233, 1.1274. This is the next major hurdle here, but it's probably early to talk about gains past this level. And of course, we need to point out, and we will talk about that on our last segment today, about upcoming data such as inflation from Eurozone that can determine the trajectory of the pair. Now let's move over to GBP USD. We had some data from the old Albion as well. Let's shift to GBP USD for our chart again. Takes advantage of the USD selling we saw today, and is also helped by the UK employment report. Unemployment ticked up to 3.8% for the December-February period, but pay growth persisted, which is a main concern for the Bank of England, and keeps prospects for another rate hike. And of course, again, CPI report from the UK due tomorrow. We'll talk about that at the last segment of today's session. Now, above the exponential moving average, the British pound can set new 2023 highs towards 1.2667, but we are again a little bit cautious at this stage for more. On the other hand, the two-day decline creates risk for sub 200 EMA. The black line here moves at around 1.23, 1.2275, but the next major support at mid 1.20s looks distant. The British pound has an advantage here, but the outlook is probably a bit mixed. Markets on the one hand seem to think that the worst is probably over for the UK, or at least they're priced in, and given the recently dovish conservative, let's say, stance by the Fed, dovish may be an overstatement, this further works in favor of the pair. On the other hand, markets are probably too optimistic about the Fed's path, and this could weigh again on the pair. In any case, the Bank of England doesn't look easy to go. It seems to be closer to the terminal rate. It's more likely one more perhaps, and then stop. And although the Fed is also looking at one more at this stage, its stance seems to be more aggressive than the Bank of England. So now let's switch gear and go to US oil. And again, we have quite a few developments to talk about there, even though the technical outlook has not changed much from what we have discussed previously. So here we are with US oil. So what we had today was a data dump from China, which showed that the recovery momentum maintains its pace after the country actually ditched the restrictive COVID-19 rules that had harmed economic activity. Q1 GDP expanded by 4.5% year over year from just 2.9% previously, and that's the highest in around the year. Retail sales jumped 10.6%, the highest reading since in nearly 2 years, and industrial output was also quite strong at 3.9%. Now this, of course, we need to remember that China is the biggest oil importer, and this should have helped oil prices, but they haven't really done so, because also markets digest prospects of a not so conservative Fed, let's say, and also of recession. Last week, both OPEC and the International Energy Agency had maintained their 2023 oil demand growth outlook. The latter also commented on the recent OPEC Plus cuts, and it said that those will likely aggravate the expected oil supply deficit in the back half of the current year, and this does not bode well for economic recovery and growth, and this probably is what is a factor that markets contemplate when thinking about prospects of global growth. Last week, we talked about the RSI divergence, which could lead to further losses. That's what happened. The commodity is now vulnerable to the critical 77.50, 77 region here, where the 200-period EMA, the ascending trend line from the 2023 lows, and the daily smoke cloud all converge. Daily closes below would hold the upside bias, but that would need a strong catalyst. Even with various headwinds and various asterisks, the fact of the matter is that we're looking toward tighter oil markets, and China's reopening is also a supportive factor. Sluggish or not sluggish, still all projections point to better days compared to what we saw last year. Bulls are clearly on the driver's seat and can set new 2023 highs, but don't really inspire much confidence at this stage for tackling 90.36, because even with tighter markets, the projections are for a roughly balanced supply and demand over the course of the year. Okay, we're already 3 minutes into the US session, so let's go and check the Nasdaq, the tech-heavy index. Has been consolidating over the past couple of weeks, as you can see here, following its 2023 highs, but is a bit today due to China optimism and solid earnings we saw from late last week, and expectations for more at this stage. We'll see how that will go, but in any case, the index has picked up momentum again and tries to set new break new ground. The next major resistance is located at 13,724 here, but it seems to be early perhaps to talk about that. There are prospects of recession. Again, we have talked about that last week. The Fed's accounts of the last policy meeting from last week showed that staff now projects a mild recession for the year. We also had the hawkish commentary by Governor Waller and various other things going on that so that markets may be over optimistic here. This consolidation does create some risk for pressure back towards the 200-period EMA around 12,730. 30, but daily close below it within the strong catalyst. And once again, we can find quite a few support levels after that. And with that said, now let's turn to what's ahead. We have inflation figures from various countries, starting with the United Kingdom on Wednesday morning. CPI had re-accelerated in February at 10.4% year over year after 3 straight monthly declines, forcing the BOE to another rate increase. Later on the same day, we get the Eurozone figures. We already have the final for March. We already have the preliminary ones. So headline had fallen sharply to 6.9% from 8.5% final for February, but core had actually ticked up to 5.7%. So this follows a familiar narrative of headline figures declining, but core ones, which exclude energy and food prices, remained much more sticky or even going a bit higher. And then on Thursday, New Zealand for the first quarter inflation, it had stayed in Q4 to 7.2%, close to its 32-year highs, still too high according to the Reserve Bank of New Zealand, who had increased rates again at the beginning of the month. We also expect a series of speeches throughout the week by various central bank members, and of course we have the earnings season. This week focus shifts to Netflix. Later today we have also posted a thorough preview of those earnings, what we expect. And you can find that on your respective FXCM market analysis website of your respective region. In any case, in focus for me will be the subscriber figures and how the recently launched ad-supported tier has fared, and of course the progress on paid sharing on its effort to crack down on password sharing. A day later, Tesla takes up the baton. The leader of the electric vehicle market has already announced record, albeit underwhelming, delivery and production figures, and the gap between them persisted. That has created fears over demand and has led Tesla to price cuts, putting the spotlight now on profitability and on margins, among other things. Of course, Tesla has industry-leading margins, so it can probably weather any, for instance, price war and market rate cuts, but we will have to see what's the impact on margins and how markets will react to it. That's again Wednesday after markets close. So that's pretty much it from us, and we will have our next section as always on Thursday, 10 minutes before Wall Street opens. Thank you for joining me.